Hello, hi. My name is Muhammad Nazim Berazi, and I'm from DMK5A. And today I will start my presentation with introduction. So the first one is the uses of financial ratios for financial manager. Financial ratios offer entrepreneurs a way to evaluate their company's performance and compare it to other similar businesses in their industry. So the ratios measure the relationship between two or more components of financial statement. They are used most effectively when results over several periods are compared. This allow you to follow your company's performance over time and uncover signs of troubles. And then sustainable businesses and mission requires effective planning and financial result and trend over time and provide key indicators of organizational performance. Manager will use ratio analysis to pinpoint strengths and weaknesses from which strategies and initiatives can be formed. Founder may use ratio analysis to measure your result against other organization or make judgment concerning management effectiveness and mission impact. So now for ratios to be useful and meaningful, they must be calculated using reliable, accurate financial informations. And then the second one is calculate consistently from period to periods, and then use in comparison to internal benchmark and goals, and then use in comparison to other companies in your industry, and then view both at a single point in times and as indication of broad trends and issue over time. And last but not least, carefully interpret in the proper context, considering there are many other important factors and indicators involved in assessing performance. And then ratios can be divided into four major categories. So the first one is profitability, sustainability, and the second one is operational efficiency, and the third one is liquidity, and then the last one is leverage, which is funding, debt, equity, and grants. So that's all from me. Thank you.
Hi, my name is Khairul Najman. So now I will be explaining about the calculation of financial ratio for the year 2020. Right, first one is current ratio. The formula for current ratio is current assets over current liabilities. So for current assets, we have 140,000. For current liabilities is 65,000. So the ratio that we get is 2.333 times. Next is quick ratio. So for quick ratio, the formula is current assets minus inventory minus prepaid expenses divided by current liabilities. So the total that we get is 80,000 over 65,000, and the ratio is 1.23 times. Next is inventory turnover ratio. The formula is cost of goods sold over average inventories. So for the cost of goods sold is 460,000 over 60,000, and the ratio is 7.67 times. Next, average collection period, ACP. The formula is account receivable over sales divided by 360. So for account receivable is 34,000, and it is over 600,000 divided by 360. So we will get 20.4 days. Next, non-current asset turnover. So for non-current asset turnover, the formula is sales over net non-current assets. So for sales is 600,000 divided by 270,000. So the ratio is 2.222 times. Next, total asset turnover. The formula is sales over total assets So for the sales, it is 600,000 over total assets, which is 400,010. The ratio is 1.46 times. Next, debt ratio. So for the formula is total debts over total assets, which the total debts is 215,000 over total assets, which is 410,000. So the ratio is 52.44%. Next, debt to equity ratio. For the formula is total debt will be divided by total equity. So the total debt is 215,000, and for the total equity is 195,000. So the ratio will be 110.26%. Next, time interest earned. So the formula is earnings before interest and tax, or EBIT, will be divided by interest expense. So the total ratio that we will get is 10 times. Next, net profit margin. So for the formula, net income over sales. Net income is 54,000, and for sales it is 600,000. So the ratio that we will get is 9%. Next, the gross profit margin. For the formula, gross profit over sales. So for gross profit, the amount is 140,000, and for sales the amount is 600,000. So the ratio for gross profit margin is 23.33%. Next, return on assets. The formula is net income over total assets. Net income is 54,000, while total assets is 410,000. So 54,000 will be divided by 410,000, and then we will get 13.17%. Next, return on equity. The formula is net income over common equity. So net income is 54,000, and for common equity it is 195,000. Also 54,000 will be divided with 195,000. So the answer we will get is 27.7%. Okay, so now I will be comparing and comment the financial ratio for the year 2019 and 2020. The first one is current ratio. So the current ratio in 2019 is 1.643 times, while in 2020 it is 2.333 times. So the current ratio for the year 2020 is higher than the year 2019. With this, hence the liquidity position for the company is better in the year 2020, and also has more than the ideal ratio, which is 2 times. Next is quick ratio. So the quick ratio in 2019 is 0.93 times, while in 2020 it is 1.23 times. So the company has improved its quick ratio, which indicates whether a firm has enough current assets to cover its current liabilities without selling the inventory. So from 0.93 times in the year 2019, it increases to 1.23 times in the year 2020. Hence, the company is more liquid in 2020 than the year 2019. Inventory turnover. In 2019, it is 7.2 times. In 2020, it is 7.67 times. So the inventory ratio indicates how many inventory were sold and replaced in a year. Higher ratio is better. The company shows an increment from 2019 to 2020, but it is not very significant, though the company managed to increase their speed in selling their inventory and replace it without having any difficulties. Average collection period, ACP. In 2019, it takes 33.6 days, while in 2020 it takes 20.4 days. This ratio indicates the number of days taken by a firm to collect its account receivable, and also reflect the company's credit policy. Mariki Berhad seems to be more strict with its own credit policy in recent years, because they managed to collect their account receivable in only 20.4 days in 2020 than the year 2019, which took them 33.6 days. Next is non-current asset turnover. So in 2019, the non-current asset turnover is 1.58 times, and in 2020, it is 2.222 times. So this ratio measures the firm's efficiency in utilizing its property, plant, and equipment in generating sales. In the above ratios, it shows that the firm utilized their assets more efficiently in 2020 than the year 2019. Total assets turnover. In 2019, it is 1.125 times, while in 2020, it is 1.46 times. Maraiky Berhad generates a higher volume of sales in the year 2020 with the given amount of assets as compared to the year 2019. And then next is debt ratio. In 2019, the debt ratio is 57.5%, while in 2020, the debt ratio is 52.44%. So the above ratios shows that Maraiky Berhad managed to lower their borrowings for the year 2020 down to 52.44%. The company borrowed more in the year 2019 with 57.5%. This means that 57.5% of their assets are financed by debts in the year 2019, but only 52.44% of their assets are financed by debts in 2020.
Debt to equity ratio for 2019 is 135.29%, for 2020 is 110.29%. The ratio above shows that Maraiky Berhad used more borrowing in the year 2019 compared to 2020 and used less equity. Next is time interest earned. For 2019 is 4.4 times, for 2020 is 10 times. This shows that Maraiky Berhad can pay their interest efficiently in the year 2020. That makes their financial performance better than the year 2019. And next is profit margin. For 2019 is 5.5%, for 2020 is 9%. In the year 2019, Maraiky Berhad produced a lower profit margin which is just 5.5% only. But in the year 2020, their profit margin have increased by 3.5%, which is 9%. It shows that the profit gain in 2020 is better than 2019. Next is gross profit margin. For 2019 is 20% and for 2020 is 23.33%. The gross profit margin in the year 2020 is a little bit higher than the year 2019. It means Maraiky Berhad produced 0.23 ringgit gross profit every 1 ringgit of sales they are made. Return on asset for 2019 is 6.25% and 2020 is 13.17%. The return on assets for Maraiky Berhad in 2020 is slightly greater than the return on asset in 2019. The fact that the net profit margin in 2020 is smaller than the net profit margin in 2019 implies that the higher return assets are related to efficiency in asset usage. This result is likewise consistent with Maraiky Berhad's non-current estimation. Next is return on equity. For 2019 is 14.71% and 2020 is 27.7%. In 2020, Maraiky Berhad had a higher percentage compared to 2019. Financial performance of Maraiky Berhad is slightly better than 2019 because they gain higher return on equity. It shows better returns to the shareholders.
Hi, my name is Ahmad Fahmi Alias, and as for my part, I would like to evaluate the overall financial performance according to liquidity, efficiency, leverage, and profitability ratios. So the first one is liquidity ratio. As we can see from the liquidity ratio, there is an increasement from Maraiky Berhad. Firstly, the current ratio. The current ratio in 2020 shows that Maraiky Berhad has done an improvement as they increase their current assets in order to repay their current liabilities. Other than that, quick ratio. The quick ratio in 2020 also has the same positive result with the current ratio, which is they are able to increase their instant paying ability of its current obligations. In conclusion, Marquee Berhad had a good performance due to the fact that they managed to improve their performance to pay off its current obligation. So next is efficiency ratio. As we can see from the efficiency ratio, there are few improvements from Marquee Berhad. Firstly, inventory turnover. The ratio in 2020 shows that Marquee Berhad competent to overcome the low indicates poor sales from 2019. They sold inventory faster. Secondly, average collection period. Marquee Berhad already tightened their policy toward the debtor and they achieved a shorter collection period in 2020. Lastly, non-current asset turnover and total asset turnover. Marquee Berhad reached their limit as they used their assets efficiently and production of product also increased. In conclusion, Marquee Berhad has good performance when it comes to being efficient in handling their assets. So other than that is leverage ratio. As we can see from the leverage ratio, there are also improvements from Marquee Berhad. Firstly, debt ratio. The debt ratio in 2020 shows that there is reduction of debt. This state shows that Marquee Berhad managed to reduce their debt from other people as it can potentially burden the company. Next, debt to equity ratio. The debt to equity ratio in 2020 also has reduced as Marquee Berhad is willing to pay off its obligations by using the right amount of debt equity ratio in order to manage the company's solvency. Lastly, times interest earned. The stats shows that Marquee Berhad has much bigger times interest earned as the company is able to increase their ability to meet its debt obligations based on their current income. In conclusion, Marquee Berhad has good performance as they manage to be able to reduce their debt ratio and earn bigger times interest. And last but not least, profitability ratio. As we can see from the profitability ratio, there are few increase from Marquee Berhad. Firstly, net profit margin. The net profit margin on 2020 shows there is an increasement due to the company's effort to run the business well. Next, gross profit margin. The gross profit margin in 2020 also has an increasement as the company managed to execute their plan to have more sales. Other than that, return on assets. The stats show that Marquee Berhad will have higher return on assets in 2020 as the company is able to be more efficient and productive at managing its balance sheet to generate profits. Lastly, return on equity. The stats also show that Marquee Berhad have higher return on equity as the company managed to provide a better return to its equity holders. In conclusion, Marikeh Berhad has the potential to reach more profitability in future. That's all from me.
In conclusion, I am convinced what the loan will be approved since we meet all of the requirements. Marikeh Berhad is a manufacturing company that has been in operation for half a decade. This has been a long journey with a lot of learning and improvement. Lower debt ratio. This is essentially a measure for the bank to judge how comfortable they are with our firm net income or profit level, as well as our ability to fulfill loan repayment from company income. This is calculated by dividing net income by debt service obligation, which are essentially our principal and interest payment. As a result, it informed the banker how many times we could return the loan using our net income. Our company has a lower debt ratio since it reduces the risk of potential loss in the case of bankruptcy. Large capacity. This can be measured by using profitability ratios such as operating profit, margin ratio, gross profit, margin ratio, net profit, margin ratio, and return on asset ratio. The primary purpose is to assess a company's potential to make profit in relation to revenue, balance sheet, and asset. And shareholders. Marikeh Berhad has a high ratio margin, which demonstrates our company's ability in generating profit while keeping costs under control. They also assist the lender in determining the rate of corporate growth and our ability to repay. Collateral. Bank will look to collateral. Collateral is an asset that a lender accepts as security for a loan. If the borrower defaults on the loan payments, the lender can seize the collateral and sell it to recoup the loss. Collateral is something that the bank can sell for cash fairly quickly to repay itself in case you fail to repay the loan. This can be measured by asset test ratio, a liquidity ratio that measures the ability of a company to pay its current liabilities when they come due with only quick asset. Quick asset are current asset that can be converted into cash quickly, usually within 90 days. Lower leverage ratio. This is a ratio that shows how much borrowed money versus our own money is being used to expand the company. They prefer it if you contribute something as well. The leverage ratio is derived by dividing total liabilities by total equity in your organization. The leverage ratio of our company is lower. A lower leverage ratio indicates that debt is used to fund less asset or capital. This is appealing to banks and creditors because it suggests a reduction in existing risk. In this case, we want to emphasize our company's ability to respect medium and long-term debt, commitment in terms of repayment of change as well as interest change. Stable condition. This final variable pertains to the economy. Factors outside of control such as an economic downturn in general or specifically within industry or the bank already having money loans within the same industry may result in the bank passing the loan because of the higher risk. Marikeh Berhad has been in existence for almost 5 years and we have excellent finance and planning as we have overcome numerous challenges throughout the operation of our business, and I am confident the bank offers enterprise with the long and significant track record professional treatment.